Okay, we'll get started. So thanks for joining us this morning. We're doing a webinar on navigating currency conversion and pension transfers to Australia. I'm joined by David from Halo today. David, are you there?
I am. I don't know if you can hear me though. I haven't had a chance to test the microphone.
Yes, I can hear you. That's fine. Not a problem at all. So yeah, I'll be taking you through pension transfers to Australia later on. In the meantime, David will take you through the currency conversion aspects of moving to Australia. We will have questions and answers at the end of the whole session once both David and myself have spoken. If you can pop your questions in the Q&A part of the webinar rather than the chat, that would be good for us. And then we'll make plenty of time at the end to go through all those questions. So we get started with David talking about Halo and currency control.
Thanks for that, Paul. And big thank you to Paul and for BDH Sterling for setting this up. From my perspective, foreign exchange timing is everything, and so this is a very short encapsulated version of a presentation to talk you through some of the aspects of managing your foreign exchange when you're moving funds overseas. Not just for pension, but for other things as well. It's all applicable. So I've been trading foreign exchange for 28 years, and we formed Halo Financial about 19 years ago, specifically to work with people who need to move money across borders, private clients and corporate clients, and to help them time their transactions to the best effect and help them manage the risk of adverse currency movements. And we'll talk a bit about that in this little seminar. We've worked with BDH Sterling for well over a decade. I couldn't quite work out exactly when we started working together, helping their customers to plan their currency transfers for their pension transfers, but also for other things. This first slide here really is just talking about some of the influences that affect currency exchange rates. You'll be very familiar with a lot of the things that impact that, certainly at the moment with interest rates being dominant, the Reserve Bank of Australia raising the interest rate slightly unexpectedly for some last week, and the Bank of England is due to raise their base rate by 25 basis points this week. But it's the rhetoric that comes along with that in the statement that is probably more influential, because it does seem like the RBA are probably at the top end of their range, maybe one more hike, and the Bank of England are probably at the top end of their range, but we're not quite sure if they'll go again. But there are so many other influences. Australia in particular is a major exporter of commodities and raw materials. So the impact on the values of those commodities due largely to the Russian invasion of Ukraine and the reduction in supply of raw materials, that's very influential on the value of the Australian dollar, and we've seen a very volatile sterling Aussie dollar rate over the last few years as a result of that. But there are obviously other influences as well. Australia's #1 export market is China, so we watch the Chinese data very closely. As that market moves, growth ebbs and flows, we do see an impact directly on the Aussie dollar, and that has obviously a direct impact on the value of your money when you're trying to buy Australian dollars. So in the next 15 minutes, we're going to talk about those things, and we're going to talk about the markets themselves, exchange rate movements, and we'll talk about the tools that you can use, both to take advantage of attractive exchange rates, but also to target exchange rates and manage the risk of negative rate movements. On the next slide, we can see Paul is controlling the slide, so I'm trying to give him gentle hints about when I'd like to move on. But on the next slide, you can see that sterling Aussie dollar exchange rate and just how volatile it's been. The foreign exchange market is the largest financial market in the world. The Bank of International Settlements does a survey every 3 years. In the latest one, they estimated that $5.1 trillion US dollars per day travels through the foreign exchange market. So it's massively larger than any of the share markets in the world, and the volume in that is mostly speculative. So these are hedge funds, these are algorithmic trading platforms moving enormous sums of money in and out of the market on a daily basis, and sometimes on a split-second basis. It's also an over-the-counter market, so there's no central hub like you would have with a share market where there's a set price in the middle and everybody works around that. In this market, UBS might be trading with the Reserve Bank of Australia, might be trading with Barclays, might be trading with Credit Suisse, and all are trading in the same currency pairs, but at slightly different exchange rates. So timing of transaction is sort of a more of a general thing than a very specific link to a particular price. And it's a pure supply and demand market. So the mention I had earlier of China and its influence on the value of the Aussie dollar, the influence is there because investors will take positions ahead of data announcements rather, and they'll shuffle their positions after those data announcements. So when Chinese data is due to arrive, the Aussie dollar tends to get very volatile, which is either a risk or an opportunity, depending on how you use that. And as being a speculative market, obviously it's driven by the traditional factors of fear and greed. So we see a lot of movement. These figures here show the range of the Aussie dollar. The range over the last year has been in sterling Aussie has been between about 165 and 190. So for every 100,000 sterling that you would be converting, that's a difference of 25,000 Aussie dollars. As you can do the maths yourself. But so that does make an enormous difference if you get the timing right. And obviously it can make an enormous difference if you're unfortunate enough to be at the wrong end of that. So the job we do is to try and make sure that you're at the right end of it, or at least in the top 10%. The next slide we come on to talks a little bit more about our company and what we do. When we set the business up, we set it up to provide a service, and I think that's the reason we work so well with BDH Sterling, is that their ethos is very similar to ours. That it is all about service, it's all about quality of delivery of service. So every client of ours gets a dedicated currency specialist to look after them. Again, much as BDH does with their clients. We'll provide guidance and analysis and information that help people make decisions about when they would want to convert funds, whether they've got target levels that they're trying to achieve which are reasonable or out of reach. And we help work with them to make sure that they're managing the risk of currency movement so that they're not caught out at the last minute. Because as Murphy's Law states, if you're having to wait to the last minute to do something, the chances are it will be the wrong time. We provide what we call a free currency health check. It's really just to understand what you're trying to achieve, how how it would work best for you, and how we can fit into that to make sure you get what you want out of your currency movement, because these are large sums of money, and it's getting it right is so important. And obviously, because we're regulated by the Financial Conduct Authority and we're governed by all of their regulatory rules, all client funds are held in segregated client accounts, and funds that are that need to be safeguarded are safeguarded in the right way. And our service, as you'd imagine, is fast. Everything's sort of almost immediate these days, and we work with clients over the phone or online, dependent on how they would wish to proceed. To a large degree, both of those things are the case, because people often want to have a discussion about their requirements, but when it comes to executing their monthly trades, they very often would like to just do that online. The next slide is a little bit more about the types of contracts and techniques you can use to protect yourself with foreign exchange. if you're looking to convert money in the here and now, you have sterling available, let's say, and you're looking to buy Australian dollars, and the exchange rate is one that you like, then you take part in what's known as a spot contract, buying on the spot. We agree an exchange rate with you, send you a contract to confirm all of the details. You deposit the sterling into our client account in the UK, and then you give us the details of the Australian bank account you would want the money sent to. If in the case of a SIP transfer, let's say, then that would be an arrangement via BDH Sterling in order to make sure that the funds are available from their from their pot, your pension pot, to settle that, and we pay the funds to the designated pension fund in Australia. If the exchange rate is particularly attractive now, but you're actually not in a position to move the funds yet, but you'd like to take advantage of that exchange rate, you can fix that exchange rate in what's known as a forward contract. So the exchange rate is agreed today, the settlement date is agreed today, and then the funds are actually exchanged on that future date that's been agreed. And for that, there's a deposit to be paid up front and the balance paid in the future. So you can keep your funds fairly liquid in the UK if that's what you wish to do, and then make a payment in the future. In order to get the right exchange rate, we operate with a system called of market orders, or interbank market orders. These are decisions you would make to say, I want to target, let's say, 1.9 on the sterling Aussie dollar exchange rate, and I've got plenty of time on my hands, so I don't need to book it today. And if we all agree that there's a good chance that that 190 is going to be achieved, then we can place an order in the market to trigger when we get to that level. No, it costs nothing. It sits there as a latent order. It's something that speculators use when they're looking to target particular exchange rates, but we use it in the physical delivery market because that's where we are. But it does mean that, as you can imagine, the Aussie dollar against the pound exchange rate is very volatile in the changeover between London closing, the Far East markets opening, US closing, and those sort of times of the day. So it's a 24-hour thing. This order would sit in the market and wait to be triggered for as long as you wish it to. They call them good till cancelled. So you can either wait until it gets triggered, or you can move it, or you can cancel it. And as I say, there's no cost to that. The sort of reverse of that is that if you know that your plans don't work unless you get at least, let's say, 185, then you can place an order in the market to guarantee that you receive 185 on what's known as a stop loss order. As you can see from the title, it's based on speculative trading, but it's a technique that we can use to guarantee that you convert your sterling into Aussie dollars at no worse than 185. And obviously, if that's triggered, then we would call you, or if a limit order is triggered, is triggered, we would call you and discuss whether you wanted to take that on a spot basis or whether you wanted to book that as a forward contract, in which case we'd agree the future date for that. So they're tools that are generally used in the speculative market that we have adapted to use for clients who are looking to buy currency for delivery. There's another contract that's not mentioned here, which a lot of people find very useful. When you move to Australia, it's very often the case that you've got some residual amounts that come through on a monthly basis. It's either rental money from the UK, or it's ongoing pension payments, or it's payments back to the UK to cover rental or mortgage payments. So there's a lot of clients have funds that are moving on a monthly basis after they've moved the bulk of their funds, and we can cover that on a fixed exchange rate with what's known as a regular currency transfer. Effectively it's a series of forward contracts, but agreed at a single exchange rate. So you can budget effectively for those extra monies that are moving on a monthly basis. And so that's something that's used a lot by clients who are migrating, but still have some financial interests back in the UK still. The next slide, thank you, Paul, is really just our tips for making sure that you get the best out of your foreign exchange needs. And the first and most important, and I'm sure that's exactly what BDH Sterling say to their clients, is plan early. You know, do your research early, have a really good think about when things are going to need to happen. But if you start making plans well in advance of the actual move or advance of the pension being moved, then you'll have a much better idea through conversation with our consultants on the desk here. You'll have a much better idea of what you want to achieve, how you can achieve it, and some of the tools and techniques you can use to make sure you take advantage of those things. Really don't leave it to the last minute. It's Murphy's Law, as I say, that the last minute is going to be the worst rate, but we can avoid that. And the other thing is that I would suggest you do not start buying currencies, even booking forward contracts or anything, until you know you've got your visa and you absolutely know that you're, you know, it's a definite that you're going, because otherwise you'll have fixed a contract in the financial markets that you then have to unwind, and you know that can be costly if the exchange rates move against you. You're very welcome to register for an account, a Halo account, well in advance of needing to move any funds. We can then start feeding you updates on the sterling Aussie rate and general market tips. And we provide a market update on a daily, weekly, monthly basis, and you know, ad hoc when there are big movements in the exchange rate. So you're very welcome to sign up for those market updates. There's a little QR code on there that is for my colleague Geraldine, who works very closely with BDH in order to help their clients. She's backed up by a team of consultants on the private client desk, but if you want to scan that or contact us, then the information is all there. And I think that concludes a very, very brief run through of what the foreign exchange markets are all about. But I'm very happy to cover any questions you would have at the end, and I'm sure there are some.
Excellent. Thank you very much, David. So I'll take you through types of pensions, why transfer, and yeah, just the advantages of why you might transfer your pension to Australia. The headline really for that is if you were to transfer most types of pension to an Australian scheme and then draw from that when you're in retirement, you would receive tax-free income as opposed to being taxed if you draw from the UK. So I'll take you through the various aspects of that during this webinar. So first of all, types of UK pensions. So there's some that can be transferred to Australia, there's some that can't. So the majority of company pensions can be transferred. Private pensions, so things like personal pensions and SIPs, can be transferred, and funded public sector defined benefit schemes, so final salary or career average, revalued earnings pensions. When we say funded public sector ones, there is a difference between different public sector schemes. So the main one that we would see on a regular basis that is a funded public sector scheme is the local government pension scheme. So that can be transferred to Australia. Schemes that cannot be transferred are the UK state pension. So you'd still be able to draw on it and transfer it to Australia, but you won't be able to transfer your entire amount and over to an Australian scheme and draw from that. Government unfunded public sector schemes. So these are, and sorry for anybody that's got one of these, but unfortunately they cannot be transferred. And the main ones here are the NHS, the Armed Forces, the Teachers Pension Scheme, the Police Pension, the Firefighters one, and the Civil Service Pension Scheme. Unfortunately, none of those can be transferred. Again, you'll still be entitled to draw on it when you get to retirement, but unfortunately you will be taxed on it in Australia, and you can't transfer your entire benefit over to an Australian scheme. Company pensions that are in the Pension Protection Fund, these are fairly few and far between, but any scheme that has entered the Pension Protection Fund can't be transferred unless later on it exits the Pension Protection Fund, which can sometimes happen. Company pensions that are already in payment, so if you've already started drawing from a company scheme, then you will just have your annual pension coming to you, or monthly pension coming to you, and you transfer that again to Australia, that pension income, but you won't be able to transfer your entire benefits over there. So again, you will be taxed in Australia on that. And similarly with an annuity that you've already purchased in the UK that you're drawing on, then again, you can't transfer your entire benefits over to an Australian scheme. So talking about types of company pensions, so there are two different ones. So there's the defined contribution. So it's defined by the contributions that you've paid into it and the investment performance over time as to what sort of funds you have available at retirement, and therefore what you're able to generate in terms of income, particularly if it remains invested throughout your retirement, like most Australian schemes do. So that's one type of scheme. Then you have the defined benefit scheme, again, usually called final salary, career average, revalued earnings, or those various different hybrids there. So within those schemes, you have a defined benefit, you have a defined annual pension, and maybe a lump sum entitlement as well. You don't actually have a fund value as such, unless you go to the scheme and ask them to produce a transfer value. And we can then look at that transfer value and work out whether or not it is in your financial interest to transfer your pension to Australia. So much as I talked about the tax benefits of being able to draw tax-free in Australia as opposed to being taxed in the UK, we have to do some proper projections to work out whether you will actually be better off on a gross basis than you would on a net basis. So that's very basically the difference between different types of company pensions. Now, if you've got a personal pension or a self-invested personal pension, or even a SAS, then that is a defined contribution scheme. So it is defined by the contributions that you've paid in and the investment performance over time. So why consider transferring? I've already mentioned the tax benefits, but also if you've got a scheme in the UK and you draw on it, as well as potentially being taxed in Australia on it, you also have to consider that you're receiving an income in pounds, but you're living in dollars. So it's a case of managing that that side of things. And would you perhaps be better in transferring your funds to an Australian scheme where you can have your entire funds denominated in Australian dollars, and that would make it easier for you to budget? Estate planning. So with a lot of defined benefit schemes, you might only get, for example, a 50% spouse's pension. Whereas if you were to transfer to a different type of scheme, the 100% of the value of that scheme would be able to be paid out to your beneficiaries on your death. And also scheme funding deficits. So a lot of final salary type schemes, defined benefit schemes, are underfunded these days. What that basically means is if they had to pay all of the benefits out, they wouldn't be able to. Now, it's not necessarily something to be worried about with most schemes, because most schemes are a long way from ever ending up in the pension protection fund. But if you do have concerns and the results of projections, etc., are favourable, then that might be another reason to be transferring the funds, so that you don't end up falling into that pension protection fund and then not having the options that you might have otherwise. Investment control. A lot of people like the idea of being able to take their funds and invest them and be able to have a bit more control over the returns that they might have in the future. Having said that, if you are in a defined benefit scheme, then the investment decisions that are made make no difference to the annual pension that you have, other than perhaps if it really does struggle on the funding side of things. But most of the time, it doesn't affect you at all in terms of what you would be able to receive. If you did transfer out, then you would have to think about the investments and making sure that they did what you needed them to do. There are no guarantees when it comes to investing funds, but when we do our projections, we use realistic growth rates based on what we would expect you to be able to get from that type of arrangement. Tax treatment. I've already mentioned about the tax-free benefits that you can draw on retirement. Most of your funds can go over to Australia tax-free as a transfer as well. There may be an element that would be taxed when it goes in, but it would only be the growth on your fund from the day that you enter Australia to the day that you actually transfer the funds. So anything that you had in the first place can go in tax-free into Australia. Also, another reason to be looking at transfers is a lot of people have multiple pensions from different employments over time, and it's an opportunity to consolidate those pensions. Now that you're moving abroad and you're having to make decisions about what you do with your assets, it might be a good opportunity to get everything under one roof, invested consistently for you as well, and potentially, as I said, get it into Australian dollars as well, which would be more suitable for your lifestyle going forward. So before you transfer, depending on how long you've still got to go in the UK, there could be an opportunity to try to maximise the contributions that you make into your pensions in the UK. In the UK, when you pay a contribution, you get tax relief on it. In Australia, if you're paying into a superannuation, as they call it over there, you do get a tiny bit of tax relief. Contributions are taxed on the way into the pension, but they're only taxed at 15%, which might be less than you would pay if you received it as an income. But in the UK, you get much larger tax relief. Now, if the end goal is to transfer your funds to Australia and get tax-free benefits at the end, then that's a really good opportunity to get some tax relief that you will effectively never give back. For once, you get one over on HMRC, which is rare, but take the opportunity maybe while you can. Okay, so why might transferring not be best for you? Well, it's not always cost effective. It depends on how much you've got in your pension as to whether or not the potential costs of moving your funds over there, both in terms of what BDH Sterling would charge for dealing with it and setting up pensions in Australia, it might not be cost effective. So, you know, if you've got £20,000 in your pension, then you may find that it's not a worthwhile exercise, and you might be better to just draw your funds in retirement in Australia, albeit taxable, but you'll have tax-free thresholds that you can use over there. Whereas if you've got £1 million in your pension, then you might find that it's a lot more cost effective to do that. You might find that your current scheme is providing much better performance if you are invested in a defined contribution type scheme, otherwise very often called money purchase schemes like a personal pension. Then you might find that the scheme performance is very good compared to what you might be able to get elsewhere, and you might be reticent to therefore leave that, certainly in the short term, but maybe later on it's still worth exploring a transfer when you get closer to retirement and you're making those retirement decisions. You might also find that your scheme charges exit penalties. It's rarer than it used to be, but there are still schemes out there where you might find that you incur an exit penalty that may well drop off later on when you get nearer to retirement. So it's not necessarily that you wouldn't explore a transfer, but just at the moment it might not make sense to do that. But again, we can assess that for you and work out whether it's likely to be cost effective for you. And the other main reason, and I touched on it earlier, is that you might not be comfortable transferring the investment risk from a defined benefit type scheme where you effectively have no investment risk at the moment, but you would do if you transferred to an Australian scheme where you would be invested before and most likely throughout your retirement. So it depends on how comfortable you are with shifting that investment risk. But again, you know, we can explore that with you, talk you through it, do the projections for you, and you can then make up your mind as to whether or not that's a risk that you're willing to take. One thing that actually just going back to that is that although if you did keep your funds in a defined benefit scheme, you wouldn't have any investment risk. Of course, if you're living in Australia and you're living in dollars, but you're drawing a pension from your defined benefit scheme in pounds, then you would have the exchange rate risk there, which you can help to mitigate a bit, like using the services of Halo that David took you through earlier. So the regular currency orders, or letting your funds build up in the UK for a while and then using spot contracts or market orders to try and get the amount that you want. But one way or the other, it will fluctuate throughout your retirement. So one thing that I haven't touched upon yet is that if you do want to transfer your pension to Australia, you can't actually do so until you're age 55. And that's likely to go up to 57 in a couple of years' time, when the minimum pension age in the UK is due to go up to 57. So that's in 2026. So you can't actually make the transfer to Australia yet, but you might have funds in the UK. You still want to do maybe a consolidation effort, and we can look at managing those funds for you in the UK while they remain here. And there are a couple of advantages of potentially doing that. So we can use a self-invested personal pension in the UK, which is a personal pension where you have a lot more investment control over it, or we can manage that investment control for you. But one of the main advantages that we've got in the way that we've set things up for our clients is that we can denominate that pension, even though it's still sitting in the UK, in either sterling or dollars. Or you could have a mixture of the two if you only want to convert some of your fund at the current time and wait to see what happens with the exchange rate with the rest. Then we can split the funds between the two, and we can invest those funds in sterling or dollars until you're ready to make the transfer over to Australia. When you're in a SIPP, then like a personal pension or other defined contribution type schemes, 100% of your pension will be passed to your beneficiaries if you pass away under the age of 75. If you pass away after age 75, there might be some tax to pay for your beneficiary, but if that beneficiary is living in Australia, then they may not have to pay any tax on that. And you can have input into the investment of the pension, or you can leave BDH Sterling to invest those funds for you. So it gives us a lot more control over what happens with your funds while they have to remain in the UK. So if you're age 55 or over, you can make a transfer, but it has to go to a superannuation fund in Australia that has qualifying recognised overseas pension scheme status. So that just means that they've got permission from HMRC in the UK to accept tax relieved money from the UK. And they have to adhere to certain rules during the first 10 or maybe even 5 years that the funds are in there. Now, those rules are essentially that you can't do anything with that pension that you wouldn't be able to do with the UK pension. But since we had flexibility brought into our pensions a few years ago, those restrictions are negligible really in terms of what you can do with your pension. The one thing that I should say is, although you can transfer at age 55, in most circumstances you can't really draw from your pension in Australia until you're age 60. Now, if you are fully retired at that time, you can draw tax-free benefits. Otherwise, if you continue working, you can go into something called transition to retirement. But from age 65, whether you're working or not, those benefits would become tax-free. Okay, so just a little bit more about QROPS. So it was only actually introduced in April 2006, this QROPS rule. Until then, you could transfer to places like Australia, but it was very convoluted and there were a lot of restrictions in place. The QROPS regulations were brought in to make it easier for somebody to move their pension to another country, particularly if you're moving your funds to the same country that you're living in. There have been various legislation changes since 2006 as the government saw things developing and saw what people were actually doing with their pensions. But these are the sort of headline things that have changed over that time. So I mentioned earlier about the NHS, the police, teachers' pensions, etc., that can't be transferred to Australia. Now, that was only actually brought about in 2015. when we had new flexibility in the UK that I hinted on just now. At that time, the government decided that that they didn't want people transferring out en masse from these government schemes, and they were also concerned that people didn't really understand the benefit that they were giving up. So unfortunately, you can't transfer from those types of schemes. HMRC also introduced the pension age test. Now that's the age 55 thing that I talked about earlier. When HMRC took a closer look at Australian schemes, they were a bit concerned that people could draw benefits under the age of 55 in circumstances other than serious ill health, which is the only circumstance in the UK that you can draw benefits early. So as a result, they actually removed all the Australian schemes that had cure-ups from the cure-ups list overnight, pretty much. So we were in a position at one point where we couldn't make transfers to Australia, but that has changed. There is a retail scheme available now that you can transfer to, but a lot of people transfer to a self-managed super fund. So it's similar to a SIPP in the UK, in that that you have full investment decisions. You can invest in anything you like within pension rules. It's just, it's a little bit more complex than a SIPP in the UK, but that is an option and it will get cure-up status as long as you're age 55 or over. In 2017, the government also introduced a rule where if you were to transfer your funds to a scheme that's in a country in which you're not living, then you would incur a 25% tax charge. So that's not a problem if you're moving to Australia and you're looking to transfer your funds to Australia. That's no problem at all. In the past, for one reason or another, we might have been looking at transferring to a New Zealand scheme because it does suit some people, but that wouldn't necessarily be a good idea now that that we've got the 25% charge. And also in 2017, the super contribution caps were reduced in Australia. So what this means is it's a non-concessional contribution. So in Australia, they have two types of contribution that you make into a pension scheme. The first is a concessional contribution. That's the bit that comes off of your salary before you're then taxed and goes into the scheme and is taxed at 15% as it goes in, that I mentioned earlier. That has its own limit, which I believe is $27,500 at the moment. Then you also have a non-concessional contribution that you can pay. Now, this is a contribution that you can make from money that is deemed that you've already paid tax on. So, for example, for a lot of Australians, it might be that they've sold an investment property, for example. They've got some money, they want to put it into their pension. They can put it in as a non-concessional contribution. Now, a transfer from the UK goes in under that same non-concessional contribution rule. So it is limited to $110,000 in any one tax year, although you can roll up 2 years to make a $330,000 contribution. If you made a contribution in the current tax year, their tax year, by the way, runs from the 1st of July to the 30th of June. But if you made a transfer in the current tax year of $330,000, then you wouldn't be able to make a contribution in the following 2 tax years. So you're not using past years, you're using future years. But that can be good, you know, when people are looking, when they've got funds that are over the 110 but within the 330, then we can use that roll up. But also for people that have much larger funds, clearly it's going to take a number of years to get the funds over there because of this limit that we have on how much we can transfer. So we would use a mixture between probably the 110 and the 330 and other strategies that we have. So if you've got a particularly large fund, that's certainly one where we would need to discuss it in a bit more detail as to what you're trying to achieve. And then we can come up with a strategy that suits you within those rules. Okay, so the main benefits of a cure-ups, well, the pension's in the same country as you are. As I mentioned earlier, it means that you can get your funds into Australian dollars. You can also continue to invest in sterling within a cure-ups if you wish to. Again, 100% of your pension passes to your beneficiaries. There is the tax favourable treatment of it, so you can get the tax-free benefits at retirement. And for those people that might already have Australian superannuation funds in place, so for example, anybody that's joining us that's already in Australia at the moment, or anybody that's previously lived in Australia and has built up some super funds, then you can consolidate everything into one place. Although that's not always suitable for people. Again, we would need to talk about the strategy for you in terms of whether it was appropriate to join your ex-UK and your Australian funds together. I mentioned very briefly earlier about the QROP's responsibilities. Again, they have to ensure that you can't do anything with your pension that you wouldn't be able to do with a UK pension. And they have reporting requirements in most cases for 10 years from the transfer. So during that period, they just have to report anything that you do with that pension. It doesn't necessarily mean that there's going to be any implications of that. It's just one of the responsibilities that they have. And if you were running a self-managed super fund, that would be a responsibility that you would have as a trustee of, or the trustee of your self-managed super fund. Okay, so just moving briefly to the transfer process. So what we would do to start with, if you want to get in touch with us, then we will have an initial chat about your situation. So not just about pensions, maybe other investments and other things that you need to know on the financial side of moving abroad. We know it's not always just about pensions. So you contact us and we'd chat through all the options with you, and then we would let you know what sort of service we can provide to you. We will then go through all the necessary fact finding with you, set your objectives, etc., and then we will do a proper pension transfer analysis report for you. So we will write a report that will show you all the things that you need to consider, the results of our analysis, and our specific recommendations as to what we think is in your best financial interests. We then review that and agree it with you, and then you can engage us to actually manage all of that for you. Now, in terms of seeking advice before you make a decision, now I mentioned earlier about some of the changes that have been made to the QROPS rules, but also things change on the tax and superannuation rules side of things as well. So getting some professional advice about it means that we're always on top of these things, and we can make sure that that we can help you through the process. Now, this is the scary one. If you were to make a transfer and get it wrong, break the rules in any shape or form, then you would actually incur a 55% tax charge to HMRC on your fund. Now, it rarely happens. It certainly doesn't happen if people are using our services, but it's just something to be aware of, and particularly with some people that make promises that are not very kosher, let's put it that way, then that can very well happen, particularly if they're looking to say that they can allow you to take your benefits under the age of 55. Now, if they say that, then that's an alarm bell, because they will be breaking the pension rules in order to do that, and you will incur a 55% tax charge in doing that. Okay, so just finally, why BDH Sterling? Well, we are dually licensed advisors, so we have offices in both the UK and Australia. We are a chartered financial planning firm, the only one that is chartered in both countries. We are defined benefit scheme specialists, so as well as BDH Sterling being specialists in that field, I am, for example, classed as a pension transfer specialist by the FCA. Which means that we've got the higher level qualifications to advise on these things. The advice is all provided under one roof. So in managing the transfer of pensions from one country to the other, we've got the UK office, we've got 3 Australian offices. We can manage that whole process of setting up a scheme in Australia, making the transfer over there between the 2 offices as well. Now, we can also provide other more holistic advice for you, particularly on the ground in Australia, helping you to set yourself up over there, helping you to set up super funds, life assurance, investments, various other things. We can also provide tax advice for you through our sister company, BDH Tax, who are duly qualified accountants. So they can help you to complete your tax returns. A lot of people in Australia have to complete tax returns, unlike in the UK. So they can also help you with your investment decisions, your retirement planning, etc. And yeah, we've got over 15 years experience in this. The directors of BDH Sterling were actually already in this market before the CUROPS rules came into place. So they remember the times when it was a lot more difficult to transfer your pension to another country. But yeah, we've certainly got the experience there. We've seen all the changes during time. We've adapted. But yeah, we're very specialist in this field. So hopefully you'd be in safe hands if you did want to employ our services. So if you did want to contact us, it's inquiries@bdhsterling.com. Everybody will also, in a couple of days' time, will be getting a recording of this webinar. So again, you could reply on the back of that if you wanted to speak with us. And it's useful when you send the email to us if you can just give us a broad idea of what it is that you're inquiring about. But one way or the other, we are happy to set up a call to speak with you in more detail about your circumstances and you know, whether or not we might be able to help you. Okay, so we've reached the questions and answers stage. So I can see that there's a few questions and answers in there. So I'll just open those up and have a look at this. So the first question, this is one for you, David. Where do you see the GBP AUD rate going?
Yeah, Paul, while you've been talking, I've been just scrabbling around trying to find my crystal ball. So I think we'll be all right. It's difficult because the world is in such a state of flux, and anybody who thinks they know the answer to that is a bit deluded. The fact, though, is that if you look at it on a long-term scale, the sterling Australian dollar exchange rate, it bottomed out in February 2013, and it's been gently climbing ever since. So the general trend is upward. Within that, though, you get a lot of volatility. The drop in from 2001 to 2013 took us from 3 Aussie dollars to the pound, which, you know, we all dream of, obviously, all the way down to about 145, and it's been climbing ever since. We breached an important milestone at 183.75. We're above that now. That's a 25% retracement. The next real target is and I won't bore you with why, but a 38% recovery, which is a Fibonacci calculation, would take us back to just over 2 Aussie dollars to the pound. So that's got to be the sort of general long-term target. How that would impact, I don't have the name of the person who asked the question, but how that would impact your specific requirements really depends on the time scale that you're looking at. And you know, that's really the conversation we would need to have with you, is what's the likely time scale, and then we can look at what's the likely opportunity within that time scale. But the trend is generally higher. Sterling is still ridiculously cheap by comparison with where it was a few years ago. Ongoing effect of you know, concerns over Brexit and what have you. But there are so many factors at play at the moment, outside of just general market economic data, that is really hard to determine over any specific time frame exactly where the rate will be. But we can certainly work on the upward trend and use that to our advantage.
Great, thanks, David. And also somebody else has asked how interest rate movements are likely to affect exchange rates.
Well, the general rule, and it's not necessarily applicable at the moment, but the general rule is that a higher interest rate in Australia, for example, would attract investment funds into the country and strengthen the currency. So that's the general rule. But at the moment, as you know, all central banks are raising interest rates, and they're at different stages of that cycle to try and fight off inflation. It's a bit of a con trick from my point of view, because inflation is an annual calculation. So we had huge inflation after the invasion of of Ukraine by Russia, huge inflation, because obviously that has an impact on the commodity markets, and geopolitical problems always cause concern in the financial markets. So we had a surge in inflation just over a year ago, and now that surge is starting to fall out of the 12-month calculation, which inflation is just a 12-month moving average. And so over time, as prices stabilize, inflation gets back to a level of normality. So central banks will take the credit for that because they raised interest rates to fight inflation, but actually inflation corrects itself anyway to a large degree. But we are at a situation now where the Reserve Bank of Australia, they raised interest rates last week. It was a bit of a surprise to the markets because many had assumed they'd finished the cycle of raising rates, but they are concerned about the property market in Australia. The property prices are pushing high, particularly rental property prices, and they're concerned about that impact on inflation. Bank of England, in their statement this week, they're likely to raise the base rate by 0.25%. That's fairly well priced in, but the statement that accompanies that is the thing that will drive the value of sterling. Are they still hawkish? Do they think there's further interest rate hikes to come, or do they feel now they've done enough to stabilize inflation? And as we know, inflation in the UK is still running at about 10%, so it's ludicrously high by comparison with their 2% target. But we're at the point of the cycle where inflation will start to decline because the surges we saw a year ago are starting to fall out of the data. So that probably hasn't answered the question to any great degree, but it's the juxtaposition between where Aussie interest rates and UK interest rates are that will drive the sterling Aussie dollar exchange rate. Generally, I think the rate is on an upward trend, but it is volatile within that trend. So the timing is, as I said right at the top of this, the timing is absolutely the key, and that timing will be determined by, the individual and their time frames to actually move their funds. So that's a bit of a roundabout way of saying I don't know, I think.
Great, thanks, David. Chris has asked, I've been told that if I cash in a DB UK pension to an Australian Kuros fund, I can take the lump sum immediately, even though I've not yet reached preservation age. Is this true? This is of interest because the lump sum pushes the value over 330,000 allowed to be put into the Australian super. Chris, I think it's probably worth you getting in contact with us to discuss that. Generally, you wouldn't be able to do that, what you're looking to do, and there might be better options available to you. For example, if you're already age 55 and your fund's only just over 330,000, then we could potentially be looking at, as part of the transfer process, and you have to do this in the right order, but potentially drawing a lump sum from the UK scheme as part of the process, so that the remaining funds would be under the non-concessional contribution cap. So again, it'll be interesting to know, a bit more about your situation and what you're trying to achieve. So yeah, if you want to get in contact, I'd be happy to discuss that in more detail with you. Oh, you've mentioned that you're age 57 later on in that. Yeah, so you said the UK pension preservation age is 65. Well, the UK minimum pension age is 55. So it may be your scheme has a retirement age of 65, but again, we'd need to look at that in more detail. You've also asked, Chris, if you make a contribution of 110 in the current tax year, can you make it 330 in the next? Yes, you can. That's a simple answer, and that can work really well. Again, for those people that are over the 330 at the current time, we might be able to put 110 in the current year and 330 in the following one. The 330 contribution, as mentioned earlier, is using up future years. So if you've only made the 110 in the current year, you haven't used any future years, therefore the following year you would have that available to you. It's you're not going back in years. So so that can be a good strategy to employ. Again, it'd be interesting to find out more about your situation and try and work out a strategy that actually suits your situation. So you've also asked what point you can transfer out of the CUROPS scheme. Well, I mentioned earlier that there is a reporting requirement of 10 years, depending on whether you're already in Australia or not. That might be more limited to 5 years. But one way or the other, while you're during that period, you can't transfer to a non-CUROPS scheme. You can transfer from a CUROPS scheme to another CUROPS scheme. And depending on your age, if you're old enough to be able to draw benefits from your scheme in Australia, then you can draw those benefits during that time. But you just can't transfer to a non-CUROPS scheme. Now, to be quite honest, apart from perhaps some cost savings, there's not massive reasons to transfer from a CUROPS to a non-CUROPS anyway. The only things would be if you were looking to invest within that scheme in something that you can't invest in within UK pension rules. For example, if you wanted to put a physical residential property in there, you wouldn't be able to do that because the UK pension rules don't allow that. But in most cases, there's no real advantages from the point of view of flexibility by moving from one to the other. As I said, it might be there's a cost saving depending on the scheme that you're looking to move to. But again, something that we can discuss in due course. Somebody anonymous here has asked if we can share the slides in the recording. Yes, we can. As mentioned earlier, you will be getting a copy of the recording. So it will take a couple of days. You will then be emailed a link to it, and at that point it will be on our YouTube channel. So that will be on there, as well as past presentations that we've done as well, if you find those useful. So Samantha has asked, when does the pension transfer age change from 55 to 57 in 2026? What does this mean for those already in Australia in terms of preparing? Well, it will change in April 2026, as long as nothing changes in the proposed legislation in the meantime. So that's when they are looking to move to 57. In terms of those already in Australia, in terms of preparing, well, it will depend on when your birthday is, which I imagine is why you're asking that question. As I said, it's April. It will be the beginning of our tax year that will change. Now, we don't know for sure whether that's going to also mean that you have to wait until age 57 to transfer to Australia. I haven't seen any clarity on that. So we shall have to watch that space. But the very fact that we've got the age 55 rule in place at the moment that is in line with our minimum pension age seems to indicate that it will go up to 57 as far as I'm concerned. Okay, so I've got Lyndall here. What if you say have 1 million in your pension fund with the yearly limit of 110,000 AUD and you want to retire in 5 years? How do you get that across as it will exceed the limits? Again, Lyndall, something I'm perfectly happy to chat with you about. We can manage that for you. There are strategies in place for those with particularly large funds where there might not be the opportunity to transfer everything over, either by the time people want to access the benefits or by the time they reach age 75, which is the limit on you can't make any further non-concessional contributions after that age. But there's always strategies available to us, and we can talk you through those strategies and work out what is best for you. But in a lot of cases, if people have been making transfers, as you said, over 5 years, if you're making 110,000, say you make 110,000 for 4 years, and then you're making 330 before you retire, then you will already then have a decent fund already in Australia that you can start to draw from while you continue to make transfers from your UK scheme to top up your benefits for later on in life. So it's not necessarily a case that you have to get all the funds over there before you retire, depending on what your retirement plans are and and what other assets you've got to draw on, etc. So again, definitely something worth getting in contact with us so that we can chat through your specific situation with you for you. Okay, anonymous one here. My UK pension administrator said that I need a report for anything over 30,000. Do you help provide that? And what are the costs, please? Is it mandatory? So yes, it is mandatory. So if you've got a defined benefit scheme, this is not if you've got a defined contribution scheme, but if you've got a final salary or career average revalued earnings, or the hybrids between those, if you've got one of those schemes and you get a transfer value and it's worth over 30,000, you have to have FCA regulated financial advice in order to make a decision on whether you transfer out of that scheme. The government introduced that just to ensure that people were getting professional advice, so they understood the difference between what they've got in the scheme at the moment and what they can achieve elsewhere, and just make sure that they make a fully informed decision when they do that. That is something that we can help you with. In terms of costs, I'd need to know a little bit more about your situation so that we can then work out the service we can provide to you and whether it's going to be worth your while. But again, please feel free, get in contact with us. I'm happy to chat through that with you and work out what the best course of action is for you. Next one is my defined benefit transfer value has gone down over 20% during the last 2 years. Should I wait until it goes back up? When do you think it will go back up? Again, a bit like David, I don't have the crystal ball in terms of what will happen going forward. So one of the main things that affects transfer values and is the reason why you will have seen your value go down in the last couple of years is gilt yields in the UK. So they are government gilts, similar to a corporate bond, where you effectively lend money to the government and then they pay you an interest rate on that, and eventually you get your money back. Those gilt yields tend to go very much in line with interest rates. Now, what we've seen over the last couple of years is interest rates going up, gilt yields going up. That actually negatively affects transfer values, because when they're working out a transfer value, one of the factors that they're looking at is if you transfer out and you go into what they see as a risk-free environment. It's not totally risk-free, but as risk-free as it can be, i.e. that you invest in government gilts, then they look at the return you might be able to get from those and then give you a transfer value that's realistic for you to potentially be able to replicate the benefits elsewhere. When gilt yields go up, they think that you're going to get a higher return on that money if you transfer out, and therefore they don't need to pay you as high a transfer value. That's a simplistic way of explaining it, but essentially that is one of the main things that affects transfer values. Now, within that, schemes can make their own decisions as to what they are willing to be able to give to people as well. And sometimes they might reduce transfer values if they're worried about the funding of the scheme, for example. Similarly, sometimes they might enhance values because they're worried about the funding of the scheme, because they want to get people out. They want to incentivize them to transfer out, so they don't have to pay the benefits in the future. They don't have to worry about being able to meet those obligations. But again, if they're struggling with their funding, then that would be something you'd be taking on yourself. You'd be having to find those investment returns yourself. So yeah, I don't have the answer as to when they might go back up. If we do see interest rates coming back down in the UK, transfer values may go back up, but there's never any guarantee as far as that's concerned. All you can really do is to see where your transfer value might be in the future. Okay, so Ryan has asked, there seems to be a significant tax advantage in moving UK pension to Australia for retirement. How likely is this to remain available? And is there anything someone under 55 can do to protect themselves from tax rule changes? Well, first of all, in terms of the tax advantages, that's just because pensions work differently in the two countries, and I don't see that that's likely to change significantly. So in the UK, you get tax relief on your contributions, you get tax-free growth as you go along. When you get to retirement, you get 25% back tax-free, and then the rest is a taxable pension. But you've had big tax reliefs up front. You've had potential investment growth on those tax reliefs as well. In Australia, as I said, you might get a slight tax advantage by putting money into a super, but it's not significant. While funds are in growth over there, they are taxed as they go along at 15%. so you don't get the same tax advantages on the growth as well. Again, that might be less than you would be paying if you were investing in other types of products in terms of tax on that growth, but they are not as tax efficient as they're accruing. But because of that, the Australian government doesn't really see a need to have to tax retirement benefits, because they're not recouping the sort of tax benefits that they've given you up front. So it's just a nice position to be in. If you're moving from the UK to Australia, you can take advantage of the rules in both countries. You know, you've had your tax relief in the UK, you can potentially get a bit more if you pay contributions in. Eventually you ship the funds over to Australia, you get them tax free. In terms of doing anything under, you know, if you're under the age of 55 and you want to protect yourself from tax rule changes, well, we don't know what the rules might change to in the future. It's as simple as that. All we can tell you is, obviously, if we were working with you, then we would be ahead of that. Most of the time we get advance warning as to things that are changing, and we have time to prepare that and to adapt our strategies accordingly. So yeah, it's not something that I can say that you can completely protect yourself against future rule changes, but certainly we can help you to navigate that as and when they happen. Okay, so so Chris, you've asked again. You said I'm in Australia and I have an Australian super, so it would be 5 years before I can transfer. Well, you mentioned earlier you've already aged 57, so you can transfer UK funds to Australia, but once they're in there, as I said earlier, they would have to remain in a QROPS for at least that amount of time. And although you're in Australia, it depends on how long you've been in Australia as to whether it's 5 years or longer. Again, you know, we can chat through the options as far as that's concerned. Brendan has said, can I start drawing on Australian super while still transferring annually from UK pension? Yeah, that's no problem at all. You know, your Australian super funds won't be affected by your UK pension. As I said, they're tax free if you're drawing from the Australian super once you've reached a certain age, and depending on your employment status. So they are tax-free over there, and if you're drawing annually from the UK, it will depend on how much you're drawing as to whether or not you're going to pay tax in Australia, because bearing in mind your Australian super is not taxable, you may well still have your whole tax-free threshold available to you in Australia, which is currently $18,200. So you may find that you're able to draw that tax-free. It is subject to tax, as I mentioned earlier. And one thing to bear in mind is if you do have UK state pension benefits that are going to kick in eventually, they will use up some of that threshold. So you may find that you're taxed at that point. Okay, so Samantha has come back and she's thanked us for answering the questions, but she said one more. It was still not clear from a UK perspective when it might be possible to transfer from a UK approved QROPS to an Aussie super scheme, everything else being equal. Well, as I mentioned earlier, yeah, if you're just moving to Australia and you're transferring at that time, then it will be 10 years at least. If you've already been in Australia for a number of years and you're making the transfer, then it may well only be 5 years from the point that you're transferring. But one way or the other, you won't be able to transfer to a non-QROPS until that point. One thing that you mentioned is there you said a UK approved QROPS to an Aussie super scheme. Well, QROPS is not actually a product as such. You know, a lot of people think that it's a specific product. It's not. It is an Australian superannuation fund. It's just one that has the necessary QROPS permissions from the UK. So, you know, in terms of, I'm presuming from your question, you mean moving to one that doesn't have QROPS status. So as I said, that's going to be at least 5 years. It may well be 10 years, depending on your circumstances. Got another anonymous one here. Even though yield have gone up, if you have an index-linked DB fund, surely the current CPI should make the transfer value increase. No, not necessarily, because the current CPI obviously will affect how your benefits might have increased in the current year. but the general expectations are that it won't stay at the levels that it's been at, that inflation will go back down at some point. So when they're looking at assessing how much they should pay you as a transfer value, they will be looking at future expectations, which would be much more in line with what the Bank of England is trying to achieve. So we are in pretty unprecedented times over the last year. Well, it has happened before, but you know, just in recent times. So yeah, that's less likely to affect it than gilt yields will. As I said, it's not just about gilt yields. That was as I mentioned earlier, a bit of a simplistic answer to why things have changed, but that is a significant part of why things change. But there's various other factors involved, not least are, as I said, the decisions that the individual scheme trustees make as to what they want to pay out as transfer values. They have the final say as far as that's concerned. So another anonymous one said, you said growth on fund will be taxed from the point when you arrive in Australia. Is that when you personally arrive or when the money is transferred? E.g., if you leave it in the UK pension fund for a year or so before you decide to bring it across, is the UK growth in this period taxable in Australia? Yes, it is. So I mentioned earlier that you can make a transfer, and the amount that you're transferring over, the amount that you originally had when you move over to Australia, can go in tax-free as a non-concessional contribution. Any growth that you earn on your fund while it's still sitting in the UK will be taxed at the point that it goes over to Australia. And now that growth part is not subject to that non-concessional contribution limit, so it can go in addition to the 110 or the 330,000, but it will be taxed at 15% when it goes in. I say at 15% if we get it right, if we can do it in the right way, so that the scheme that is accepting it in Australia can pay it at 15%. If we can't do it that way, or if you do it and you've still, for example, got UK pension funds in place, but we haven't done the right strategy, then you could end up having to pay that tax through your tax return. So you may find that you pay a higher tax rate on that. And if you're under the age of 60, you may find that you have to pay that from non-pension funds as well, because you won't be able to access the super to pay it. Yeah, it's something we can chat through in terms of what you should do and how we go about making sure that you can pay it the 15% within the fund. Lyndall's back and he said, can we top up an existing Australian super tax-free and do the 110 transfer, or is it about 110 across all payments? It's a good question, Lyndall. It is 110 across all payments. That is just the non-concessional contribution cap in Australia for the tax year. Now, it just so happens that a pension transfer goes in as a non-concessional contribution, but if you've already paid a non-concessional contribution from other money during that year, then you will limit what you can transfer from the UK pension. It is 110 overall. Okay, just having a look here. So Brendan said, not drawing from UK pension, I meant transferring UK pension to Australian super each year. Oh, okay. Yeah, so yes, again, we need to make sure that you do it in the right way, but you can continue to contribute over there if you're drawing from the super fund, depending on the circumstances, depending on what you've done. But yeah, we can certainly help you to manage a strategy that would work from that point of view. Anonymous has said, can I bring my 25% tax-free lump sum into Australia tax-free? Yeah, well, again, we've got that rule that I was saying about just now, about how growth on your fund is taxed in Australia. So if you've held your funds in the UK for a number of years, and then you're either looking to transfer your funds to Australia as a non-concessional contribution, or you're potentially taking the lump sum out in the UK, then you may find that you pay a bit of tax on that, but it will only be on that growth element, not on what you had when you originally arrived in Australia. Okay, so that's all the questions that I've had so far. Oh no, hang on, sorry, if there are a couple more. So somebody has asked, if I leave Australia, can I transfer my super back out? No, the Australian authorities do not allow a superannuation fund to be transferred out of the country. So if you're moving back to the UK, for example, you would have to manage the withdrawal strategy from your Australian scheme. Now, if you're leaving on a temporary visa, if you're going over there on a temporary visa, you're still on a temporary visa when you leave the country, then you may well then be able to draw some funds out of your super fund, but there may be a tax element to that. So whether or not it's worth doing is a different matter. Yeah, so again, we can talk through the options. If you think that's something that's likely to happen, we can talk about that for you. Okay, and Brendan says, how do I find out if my Australian super fund, Colonial First State, is eligible to accept transfer from UK pension? Well, I can answer that straight away, Brendan. It doesn't have QROP status. And I know that because there's only one retail scheme in Australia that has QROP status, and it's called the Australian Expat Superannuation Fund. That's the only scheme that's emerged since all the funds were taken off the QROPS list. It's the only one that's emerged. It's a retail scheme. All the others that you see on the list are self-managed super funds. So they're ones where people have set up a brand new scheme from scratch, a bit like a SIP in the UK, but you don't go to a provider, you set it up from scratch, which we can help you to do, and we can help you to manage that. But yes, there is only one retail scheme at the moment. The main reason for that is that, as I said earlier, the government was worried about people drawing benefits under the age of 55 in circumstances other than serious ill health. And some of the schemes over there tried to change their rules to say, well, look, if we've got somebody with ex-UK funds in there, we just won't allow them to draw it until age 55. But I think the government in the UK essentially looked at that and said, well, the overriding legislation allows you to do it, so maybe individual scheme rules aren't going to be able to override that. So yeah, but they basically said no scheme that has members in it that are under age 55 can get QROP status. So that Australian Expat Superannuation Fund has been specifically set up for people that are transferring from the UK. And you can only join the scheme when you're already age 55. So they have QROP status on the back of that. Again, if you're setting up a self-managed super fund and either it's just you or maybe you and your other half set it up, then as long as you're age 55, you can then apply for QROP status from the UK. But you will find that, as I said, any other super fund in Australia just won't have that QROP status. Okay, so Danielle, our marketing manager, has said, just commented on here to say that we do have a webinar next week on how to make the most of your super in the UK. So for that person that asked the question just now about what happens if I return to the UK and I still have super funds over there, maybe worth checking out the session next week just to see what we can potentially do if you do find yourself in that situation. Finally, Brendan says, so would I need to transfer from Colonial to the Australian Expat funds before I transfer? Well, no, you can hold your current super fund and then set up the Australian Expat Superannuation Fund or a self-managed super fund in addition to that. You can't hold more than one pension scheme. If you wanted to amalgamate your existing Australian super funds with your UK fund, then you would need to transfer the Australian super into the QROPS fund. So either that Australian Expat Superannuation Fund or a self-managed super fund. You would have to transfer the Australian one into it. Again, though, whether that's in your interest is a different matter. We would have to discuss that with you to see whether that's applicable. Okay, so looks like a couple of people have commented that they found that a good session, so I hope the rest of you did. And that's the end of all the questions for now, and pretty much the end of the time that we've got available. But again, if you do want to get in contact, then we can answer any other questions that you've got. So that just leaves me to thank David. Presumably you're still there, David?
I am, yeah. I've been learning all the way through, Paul. Thank you for that.
Yeah, so sorry, all your questions were at the beginning, weren't they?
Yeah,
But yes, thank you very much, everybody, for attending. And as I said, if you've got any other questions, feel free to get in contact. But yeah, have a great rest of your day. Thanks.
thank you.